Behavioral Finance Notes, Episode 7. Why do investors become over-optimistic? Extrapolation and the formation of market beliefs. Welcome back to Behavioral Finance Notes. In previous episode, we discussed the investor sentiment, limits to arbitrage, and how behavioral forces may predict future returns. But this raises a deeper question. If sentiment influences prices, where does that sentiment come from in the first place? Why do investors sometimes become excessively optimistic about certain assets, industries, or narratives? Today, I want to focus on one of the central mechanisms in behavioral finance, the tendency of investors to extrapolate recent trends too far into the future. In many markets, investors appear to place too much weight on recent experience. When prices rise persistently, people begin to expect further increases. When firms report strong growth, investors may assume that growth will continue indefinitely. In other words, investors often project recent patterns forward. This tendency is known as extrapolation. At an intuitive level, extrapolation seems reasonable. After all, recent information may contain useful signals about the future, but behavioral finance argues that investors frequently over-extrapolate. They mistake temporary trends for permanent changes. Consider a rapidly growing company. Suppose earnings have increased dramatically over the past several years. As investors observe this pattern, expectations become increasingly optimistic. Analysts raise forecasts, medium attention grows, narratives become stronger. Eventually, investors may stop asking whether the growth is sustainable and begin assuming that the future success is almost inevitable. At that point, prices may start reflecting overly optimistic expectations rather than realistic long-term fundamentals. This tendency is closely related to an idea from psychology known as representativeness. People naturally search for patterns. When they observe a sequence of strong outcomes, they often infer that the underlying process itself has changed. For example, investors may begin to view a successful company as a winner with exceptional long-term perspectives, even when part of that observed success may simply reflect temporary conditions or randomness. Behavioral finance suggests that investors sometimes overweight recent information and underweight long-term statistical realistics. As a result, expectations become systematically biased. Extrapolation affects the market because beliefs influence demand. When investors become overly optimistic, they are willing to pay increased higher prices for assets associated with strong recent performance. This demand pressure can become self-reinforcing. Rising prices attract more attention. More attention attracts more investors. And additional demand pushes prices even higher. Importantly, this process does not require investors to be irrational in every dimension. Even sophisticated investors can be influenced by narratives, recent experience, and social reinforcement. At this point, the connection to earlier episodes becomes important. If optimism pushes prices above fundamental value, why don't rational traders immediately correct their prices? As we discussed previously, arbitrage is risky and constrained. Betting against the optimistic markets can be extremely costly in short run. Prices driven by extrapolated beliefs may continue rising for extended periods, before eventually correcting. This means that extrapolation combined with limits to arbitrage can generate persistent deviation from fundamental value. Researchers have linked extrapolative expectations to several important market phenomena. For example, momentum in asset prices, speculative bubbles, periods of extreme valuation dispersion, and subsequent long-term reversals. In many cases, investors appear to chase recent winners while becoming extremely pessimistic about recent losers. Over time, these expectations may partially reverse. This creates predictable patterns in returns. Extrapolation is important because it provides a mechanism connecting psychology to asset pricing, rather than simply saying that investors are irrational. Behavioral finance attempts to explain how specific belief formation processing influence market outcomes. In this framework, prices are shaped not only by information, but also by the way investors interpret and project that information into the future. Understanding extrapolation helps explain why optimism and pessimism can become amplified in financial markets. It also helps explain why certain assets become especially vulnerable to cycles of enthusiasm and disappointment. In future notes, we will continue exploring how investor attention, disagreement, and information processing shape market behavior. Thank you for watching Behavioral Finance Talk.